Good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at Options Play. And I just want to say happy Thursday to everyone and hope everyone's watching this market. It's pretty crazy out there, but I do think that the topic that we're going to cover here today is quite timely for the current market conditions. Today, what I want to cover is repairing a stock trade that has gone wrong using options. And I'm covering this topic because it's one of our top requested topics for those of you that have submitted your feedback on what you would like us to cover. I consistently get questions around how do you repair a losing trade, whether it's a stock trade or an options trade. Now, I will say, I typically disagree with the philosophy of simply repairing trades because most of these strategies typically require taking on more risk, and they typically only work with very specific conditions. So my preference, generally speaking, is to just simply cut my losses and move on. But occasionally I do look at these stock repair strategies. But the thing that you have to keep in mind with any repair strategy is that there isn't a magic pill that just simply turns a loser into a winner. So it is a strategy that has a lot of limitations. And it is somewhat complex, and it only works with very specific outlooks on the underlying stock. So to say, I think the best way to really put it is that many repair strategies, the moons really have to line up in order for this strategy to work. So today, what we want to do is we want to explore the strategy itself. I want to explain to you when this strategy is suitable, and then break down the strategy into easier to understand components, and then really talk about what you have to look out for and show you how you can use options play to try to structure and seek these trades out. And hopefully some of you will find use for this. Hopefully some of you will be able to take this afterwards and find yourself a strategy that will allow you to repair a stock trade that has gone south. And many of you, after learning about this strategy, may actually find that it's just simply not suitable for you at all, or the fact that you might, the stock that you're currently looking at does not fit with a stock repair strategy. And there are a lot of them out there. So those are the things I want to cover here today. Let's go ahead and get started. And at the very end, what I'll do is I'll try to leave some time to allow you guys to submit some symbols, where you got in, where it's currently trading at, and let's see if we can find some repair strategies for those scenarios. So let's go ahead and get started here. Before I do, just a quick reminder for those of you that do not have access to an options play account, you can sign up using the link that is here on your screen. This gives you access to the tools that I'm going to discuss with you today and show you how to utilize options play to structure a stock repair trade. So to get access to it, simply click on the link and subscribe to become an options play member. And for that, you're going to get our daily options trading ideas, our weekly options education webinar like the one you're on here today, and our weekly cover call and short put reports. And for those of you that are brand new, it includes a free 12-step options trading course to help you get started. So with that, let's go ahead and jump into what we're here to talk about here today, which is stock repair strategies. So first of all, what I want to address is when you find yourself in the position where a stock that you've purchased has gone against you, what are your options? Because there are a lot of options and you should be aware of all of them before you decide that you want to repair your trade using options. If you decide that repairing your trade using options is the suitable way to go, then let's talk about what is actually a stock repair strategy. Like I said, it's a fairly complex option strategy. Even for myself, when I have to think about it, it takes me a few seconds to wrap my head around it, but I do have some ways to help you break it down so that you have a better way to understand a stock repair strategy. And then lastly, what I'll do is I'll give you an example and show you the different calculations, the different outcomes, and the factors that you need to consider when you're putting on a stock repair strategy. And then lastly, what we'll do is we'll log on to options play. And like I said, I'll go through a few different examples that I have found in the markets, and I'll try to allow you guys to submit some symbols so that we can see how easy or not easy it is to try to find a stock repair strategy. So to get started, let's first talk about the fact that you're in a stock trade that has gone wrong. What are your options? So you have a few different options. First of all, the first and foremost, and I think many people do this, is to simply hold and wait, which means that you're down 10% on a trade, and you don't really know what to do. So you just basically hold on to it and do nothing. And you're basically waiting for the stock to rally back to the cost basis of your stock and hopefully break even and hopefully some more. This is probably the most common thing that I think most people do when they have a stock trade that's gone wrong. The second thing that I think is generally suitable for those of you that are long-term investors is a dollar cost average. So if you buy a stock at $100, it's now gone down to 80. If you bought the same amount as you bought it at 80, as you bought at 100, you've dollar cost your average cost basis from 100 down to 90. So now the stock only has to rebound to 90 before you can you will break even and potentially make more money. The problem with this strategy is that it does add risk. So you're putting on more risk than you may originally have intended on adding. So, but dollar cost averaging is typically useful for those of you that are long-term investors in a specific stock, and you're simply looking to raise your investment in a specific security, and doing it over time allows you to potentially have a better cost basis. But again, not everyone has the ability to dollar cost average or wants to take on that additional risk. So suitable for some, not necessarily suitable for others. The third one is to simply sell your holdings. You bought a stock at $100, you thought it was going to go higher, but it ended up going down to 90. It's simply, this is one of my favorite things to do, is to simply admit that I'm wrong, take my loss, and take the $90 that I have left and apply it to the next stock that I think is going to go higher. What this does is it removes your exposure in the stock or ETF completely, which means that if the stock continues to move lower, you don't lose any more money. But if the stock moves higher, you also don't make any money. So not very exciting, but many times that helps me prevent myself from getting into much bigger losses than I really intend to. And then lastly, if none of those examples really work out for you, you may want to consider a stock repair strategy. Now, what a stock repair strategy is designed to do is to improve your break-even price. So if you have a $100 stock that you purchased at $100, it's down to $90. What you can do is you can try to put on a repair strategy that might change your break-even price to maybe $95. So the stock doesn't have to rally back up to 100 for you to break even. It only has to rally up to 95 before your strategy can break even. Now, this does cap your rewards, which means that if the stock rockets up to 200, you're not going to be able to participate in all of that when you put on a stock repair strategy. And in theory, if you do this correctly and if you have all the things lined up, you typically can do this for either little or no additional risk. Now, when I say you can do this with little or no additional risk, there are a lot of other factors that need to be in place before you even get to that point. So those are the things we're here to discuss, is what are those things that need to be aligned in order for this to work. So, is a repair strategy suitable for the stock trade that you're in? Number one, what I want to make sure everyone understands is that when you put on a repair strategy, it does not provide any downside protection, which means that if you have a $100 stock that has gone from $100 down to $90 and you think it might continue to move lower, a repair strategy does not protect you from that at all. In addition to that, a repair strategy only works if the stock is to rally. And not only does it have to rally, it actually has to rally relatively slowly. You can't just have a very sharp rally, because if you do end up having that really sharp rally, this strategy actually doesn't work very well. And thirdly, one of the most important things is the fact that this strategy typically only works if the stock has not lost more than 5 to 7%. Many times when I get the question from users asking me about a repair strategy, a lot of times I see stocks that are already down 20, 30, 40%. At that point, there is no magic repair strategy that gets you back to break even. especially not at one that has zero cost or doesn't add additional risk. So many times, most people do not find themselves in this position where a stock has only lost 5 to 7% and they're looking to repair. Many times, from when I hear about this strategy, it's usually from users who have already lost well in excess of 10% on their overall trade. And many times at that point, it is too late to try to repair a strategy. Now, I will come back to these points when we go through the examples here. So I do want to talk about, what are the criteria that need to happen before you even consider a repair strategy? And then once you put on the repair strategy, what needs to happen? Now, like I said, for the repair strategy to work, you must be bullish on the trade, bullish on the stock that is now down 5, 7, 10% or so, somewhere in that range. You must now be bullish. So you have to ask yourself, even though the stock's down 10%, do I now believe it's going to rally back? And if it does rally back, what a repair strategy will do is it improves your stock break-even price. So again, it lowers the break-even price on your stock. It profits if the stock rises back to its initial break-even price. So if the stock goes all the way back to its break-even price, you don't just break even, you actually are able to realize a profit. So that is one of the upsides of a repair strategy, is that if you put it on and the stock goes back to 100, you actually make a profit, not just break even. Now, this does cap the upside of your stock. So traditionally, when you buy a stock, you have unlimited upside. When you put on a repair strategy, you cap that unlimited upside. So you are giving away some upside of your stock to put on this repair strategy. And lastly, I want to continue to make sure that everyone understands that your downside remains the same. When you put on a repair strategy, you're not protecting any downside. So if the stock continues to move lower, you'll still lose more money. So keep that in mind when you're putting on a repair strategy. So let's go through an actual example, because I think that is the best way to learn. So here I have an example of a stock. It's a stock that, it's a fictitious example, but it's a stock that went from about 65 to about 100, had a very strong uptrend, pulled back a little to near its support level. And maybe you thought around this time that it was a good time to consider buying the stock because you think it's going to continue moving higher. Next thing you know, after you buy the stock, instead of moving higher, it moves significantly lower. And it kind of gives you a little chop. But because of the fact that it gives you a little bit of chop, it gives you the hope that you think the stock is going to rally back higher, meaning you don't think it's going to continue moving lower. Again, if you think it's going to continue moving lower, my best suggestion for you, get out of the stock, take a 10% loss, move on. But if you're in the camp that you believe that this stock is now going to rally somehow to maybe 95, 97 or so, and you want to just try to get yourself back to break even or make a small profit, but you don't think the stock is going to go to 105, 110 anymore, you just think you want to get back to break even, that is the scenario where you want to consider putting on a repair strategy. So again, fairly specific. But if you find yourself in that position where the stock's not down too much and you think it's going to rally back a little bit, then you want to consider putting on this repair strategy. So what is a repair strategy? Repair strategy is what we call a ratio spread. So again, we own 100 shares of XYZ at $100 a share. The stock is now down 10%. What do we do to repair our strategy? We sell a call ratio spread. Now, that sounds like a mouthful. It's a pretty complex trade. So let me try to break this down into its components. So when we talk about selling a call ratio spread, what we're doing is we're buying one call, and at the same time, we're selling two calls against it. So think about like a call vertical where you're buying a call, you're selling a higher call, and then you're selling another higher call. And that should trade at a relatively small debit or credit. So in my opinion, when you think about this particular trade, it's confusing, it's hard to imagine, it's difficult to understand. So I like to break it down into two different types of components. I like to think of it as selling a cover call on the 100 shares of stock that you own. So I own 100 shares, right? So I can sell a cover call against that 100 shares. So by selling a cover call at the original break-even price, So if I have $100 stock, or I'm sorry, if I have a stock that I purchased at $100, I would sell a cover call at the $100 strike price. And then what I would do is I would take the proceeds of that cover call and then try to buy a debit spread at the current stock price. So what I'm basically doing is I'm trying to add leverage to my existing trade and trying to pay for it by selling a cover call. That is the essence of a stock repair strategy. So if you imagine this line, let me try to make this a different color. If you imagine this being my original position, so I think it's a pretty straightforward line to understand. What I'm trying to do here is I don't want to just try to get myself back to break even by getting the stock back to 100. What I want to do is, so here I would have the stock to rally back up to 100 in order for me to break even. What I'm trying to do is I'm trying to add some leverage by buying a call option so that I make my money back faster. But because buying a call option is expensive, what I'm going to do first is I'm going to turn my call option into a vertical, which would look like that. And then I'm going to sell a cover call on top of that, which brings my trade to look like this. So those are the components of a repair strategy. Is you're really selling a cover call and then taking the proceeds of that cover call and buying a call vertical that will basically provide some gains if the stock rallies back a little bit, that offsets the gains that you also have in the underlying stock to give you a better break-even price. And I think the best way to look at this is to actually go through the numbers itself. So again, I own 100 shares of XYZ currently trading at $100. What I want to do is I want to buy a $90 call option. So the stock is down to $90. So I'm going to buy an at the money call. And let's say this cost me $3 to buy that $90 call. What I want to do is I want to sell 2 calls against that at the original cost basis of my stock and try to net the 2 off from each other. So if I sold 2 call options for $1.50, that would offset the $3 that I have to pay for that $90 call. Now, I will say that these numbers themselves are fictitious numbers. These are not real option prices. Chances are you won't be able to find option prices this good that just happens to offset each other. But again, I'm taking whole numbers for example purposes to try to make this as easy as possible to understand. So what I've effectively done is on my 100 shares that I own at $100, I've sold the cover call, sold it for $1.50, and I've taken that $1.50 and I've bought a call vertical spread. And that vertical spread consists of buying 1 contract of the $90 call and then selling 1 contract of the $100 call at $1.50. And the 3 net each other off because I've sold the cover call for $1.50. That pays for half of the $90 call, and I've sold another contract of the 100 calls for $1.50 to net off the other half of the $3. So my net debit on this whole trade is $0. Now, finding a ratio spread for 0 net debit or $0 credit isn't in itself not difficult to do, but the question is whether or not you can do it at the original strike price here, because you need to sell the cover call here at the original strike price, and you need to buy a call near the current price of the stock. And the question is whether or not these 2 strikes allow you to create a ratio at a net debit or credit. And depending on how far away this is, the further away these 2 numbers are, the harder it is to find a repair strategy. The closer they are, the easier. But many times when it's that close, you may not need a repair strategy. So that is the challenge that we have when we're trying to put on a repair strategy. But that is the anatomy of the trade. And lastly, what I want to talk about is just how do you calculate the new break even? So the reason that I specifically break up this trade into a cover call and a debit vertical spread is because that allows me to calculate the new break evens relatively easily, because the break even of your repair trade and the stock that you own is simply the difference between the 2 break evens. So if I sold a cover call on $100 stock and I collected $1.50, my break even on that cover call is $98.50. On my call vertical, because I spent $1.50 to purchase a 90-100 call vertical spread, my break even on that is $91.50. And the difference between those two is 95. So that would be my new break even on my overall trade. So what does that look like for my strategy? What does that look like for my stock trade? So again, I own 100 shares of XYZ at $100. It has now fallen to $90, and I put on the repair trade that I illustrated before. So this is the current price of the stock at $90. Whoops. This is the current price of the stock at $90. Now, what I want to do is understand how much do I make or lose on each one of these trades. So if the stock rallies $5 from 90 to 95, as you can see, if my original stock trade, I would just be down $5 now instead of down $10 because the stock's rallied $5. But in my repair trade, I'm back to break even. So that's where your repair trade starts to work in your favor. If the stock rallies $10 to $100, my original stock trade, I would be at 0. Now my repair trade, I'm actually up $5. So this is really where the repair trade shines, because if the stock rallies just a little bit or rallies back to my break even, not only do I break even faster, I actually start to make a profit. Now, if the stock rallies significantly to, let's say, 110, this is where I'm making a $10 profit on my original stock, but my stock repair trade will start to work against me from the perspective of I've capped my gains at some point. So if the stock rallies back to 110, I make the same amount of money as I do if I just kept the original trade. And lastly, if the stock rallies significantly to 120, I've again capped my returns. So no matter what happens, now my stock trade actually is better off than my repair strategy, because when I put on my repair strategy, it caps my gains so that if it rallies to 120, 130, 140, the most I'll make is just $10 a share. I can't make any more when I put on a repair strategy. And lastly, if the stock continues to decline, the two strategies look exactly the same. So again, the repair trade does not provide any downside protection. If the stock continues to move lower, you will continue to lose more and more money. So it's important to understand that it's really only in this one specific area where the repair trade outperforms owning the underlying stock. In all other scenarios, if it moves significantly lower or significantly higher, it will either perform as well, if not worse, than the original stock position that you have. So you have to ask yourself, do I believe the stock is going to rally relatively small amounts? And keep in mind that these outcomes are only true at expiration. And that is the one big caveat of these repair strategies, that prior to expiration, the strategies do not look remotely like this. And I want to walk you guys through that because it's really important to understand as to what actually happens on a repair trade before expiration. So a number of factors that you really need to keep in mind when you're putting on a repair trade. Number one, this strategy really requires patience, and you need to hold the repair trades close to expiration in order to actually benefit from the strategy, from the outcomes that I just explained to you. Because if the stock was to actually rally relatively sharply when you have a repair strategy, this is actually an opportunity where you actually may experience more losses. So this is something that's very counterintuitive. And this is the complexity of having a ratio spread, because net you're short two options while you're only long one. So if the stock rallies significantly, you can actually lose more money on the short legs than you're actually gaining on the long leg. And this is something that's somewhat counterintuitive to one of these repair trades. And this is really the complexity that I want to make sure everyone understands. Another thing that you really have to pay attention to is the fact that you are trading three legs. And this adds a fair amount of transaction costs and commissions. Granted, for those of you that trade at some of these major brokers, we just had a major announcement over the last few days that they've really cut commissions across the board for options trading, which will make this trading a lot cheaper for you. But you also have to consider the fact that there's still the spread that you have to trade between the bid and ask price. And that sometimes across three legs can be a significant amount that might actually offset a lot of the gains that you might have on the repair strategy. And this does require you to trade a minimum of 100 shares, because if you have less than 100 shares, you can't sell that cover call to pay for that vertical spread. So you have to, this has to be for stocks that you own at least 100 shares of. Now, this strategy, generally speaking, works better in higher implied volatility environments because, again, you're short two legs, and you want those short two legs to be in a higher volatility environment that generates hopefully enough yield to pay for the vertical spread. Now, I want to reiterate one more time that this trade does not work when you have losses that are greater than 5 to 7%. So if you have a stock that's down 20%, I guarantee you won't be able to find a suitable repair strategy to fix your stock that's down 20%. Usually I find that only 3, 4, 5% is the real range that you're able to find a repair strategy. Greater than that, it's really difficult to do. And lastly, you have to remember, repair strategies, you must be bullish. You must believe the stock is going to rally, and you have to believe it's going to rally somewhat slowly, because if you expect it's going to rally very quickly, it doesn't quite work. And I'll show you that in a few minutes. And lastly, this strategy does not provide you with any downside protection. Once again, I seem to get the feeling that many people put on a repair strategy believing that it's going to somehow also prevent further losses, and that's not what this strategy does. So with that, what I want to do is I want to jump over to options play. I want to show you a few different examples of trades that I found that you might be able to repair a trade that's down a modest amount. And then what I can do is I can actually, you guys can start doing this. If you want to submit a symbol and your cost basis on that symbol, I'm happy to try after I go through my examples to see if we can find some repair strategies for a stock trade that maybe has gone wrong for you. So in the chat window, if you have a stock that you are currently losing money on, please type in the symbol and your cost basis. So I was looking at the markets today. I was looking at Disney. Disney's trading at 128 right now. And I was looking at this stock because this is a stock that many people have currently owned in their portfolios. It's a stock that's very much in kind of the streaming wars and recently has taken a bit of a tumble. But I think a lot of people are long this particular stock because it's a strong name and a strong performer. So what I wanted to do is I want to take a look at, if the stock's trading at 128 right now, can you put on a repair strategy that maybe gets you back to break even if the stock was to give you a bit of a bounce here? So again, this only works if I expect the stock to rally maybe to that 132, 133 level. And I wanted to take a look at if I was able to find a repair strategy. So let's take a look at this. What I'm going to do is I'm going to modify my strategy. I'm going to use my strategy constructor. And I'm going to look at a short call ratio because that's really what I'm looking to do. Now, Disney's trading at 128 right now. I was looking at roughly the November 8th. I tend to find that if you're going to put on a repair strategy, it really only works with, call spreads that are maybe 1 to 2 months out. Any shorter than that, I think you'll be difficult to find strikes that work. Any longer than that, I'll show you in a second why longer dated options is not suitable for this. So I was looking at November 8th. The current stock is at 128. So maybe if I buy a 129 call, that cost me $4.10. What can I sell to offset roughly $4.10? As you can see, that's about 134. So if I sold 2 contracts of the 134s, that would allow me to pay for roughly 1 contract of the 129s. Now that's only a $5 move back to its break-even price. Now that's well below 5%. That's only about a 3.5% move from your break-even price. That's it. If you were down from, let's say, 140, as you can see, if I sold a 140 call for 77 cents, I wouldn't be able to pay for anything much more than a 136 call option, which means that I'm really not participating in this at all. So again, I'm looking at selling the 134s to try to fund roughly buying a 129 call option. And that's not even at the money, that's slightly out of the money. If I am buying a 128, I'm only able to sell maybe a 133 to pay for that. So as you can see, I really have very little wiggle room here. I think 129, 134 is probably suitable. So that's about a $6 move to the upside. The $6 on a 128 $128 stock is only 5%. So this only works if you're down about 5% on Disney. Can you put on a ratio spread for roughly 3-cent credit? So this is a very, very small credit. Now that is at the midpoint. So realistically, you might get filled maybe at even on this particular trade, which does mean that you're not adding additional risk to your Disney trade. But what we want to do is we want to see how does this strategy perform if this stock rallies. So in this particular case, my break even, meaning my original cost basis on my stock, is 134. So I want to see what happens if the stock rallies up to, let's say, 131 or 132. So as you can see here, if the stock rallies back up to 132, I've made a $303 profit on my ratio spread. And what I've done at this point is I've only lost about $200 on my stock because my cost basis is 134. It's now traded at 132. So I'm down $200, but I've made $303 back on my ratio spread. So if the stock rallies back up to 132, I actually make $100. Now, again, this only works if it's at 132 by the November 15th expiration. What I want to show you is what happens if this stock rallies to 132, let's say next week. So it was trading at 132 just a week ago. So what happens if next week this stock rallies up to 132? So if, let's say, next Thursday, which is the 11th or 12th, what is today, the 3rd, the 10th. So next Thursday, if the stock rallies up to 132, notice how I'm actually losing $45 on this particular trade. So not only have I not made more money, I've actually lost more money on this particular trade because, as you can see here, this is what the actual curve of the P&L looks like in the short run because you're net short 2 contracts while you're only long 1. So what happens is when the stock rallies sharply, you lose more money on the 2 short legs than you make up on the 1 long leg. Now, I will say, because when the stock is down, when you get that rally, you typically do have a contraction in volatility. So that does help a little. So if the stock, which is currently trading around 25 vol, maybe goes down to 23 vol, it does offset some of those losses, but it's something to consider that if vol doesn't come off, you can actually lose money on a repair strategy when the stock does rally, especially in the short run. Notice how most of these profits come in the last few weeks till expiration. It's only as you get closer to expiration does this profit really start to ratchet up. So you really have to be patient, and you need to, for this stock to rally back up to 132 relatively slowly. This is for a November 15th, November 8th expiration. So if you think about that, that's all the way over here. So look at this chart here. November 8th is roughly right here. So I'm basically saying that I think that this stock is going to rally from 128 to 132 over this period of time. And only in that period of time does this trade work, which means that if it goes to here or here or here, it doesn't really work. It only works in a very specific time frame. In the best strategy or the best performing scenario for this strategy is if it goes from 128 to 134. At 134, that's where the original stock has broken even, and I've made $503 on my on my repair strategy. So I've come back with a $503 profit instead of basically breaking even. So the stock needs to rally to about 134 by that November expiration date. But again, remember, if the stock is here or here by expiration, I'm not better off. Actually, if the stock is back here, I'm worse off than if I just did nothing. So keep that in mind when you're thinking about putting on a repair strategy. So instead of me trying to come up with examples myself to see how easy or how difficult it is to find a repair strategy, let me take a look at some of the examples that you guys have provided. So let's see. Ursula said First Solar, but I don't have a cost basis. Oh, she said 61 down here. First Solar. So First Solar, your cost basis is 61. Okay, so let's see. If we wanted to sell a 61 call, what can we get for it? So a short call ratio. So if I sold 2 contracts of the 61, now there isn't a 61, there's only a 60 or a 62.5. Let's see if a weekly option provides me with a 61. It does. So if I sold 1 contract or 2 contracts of the 61 for $1.84, that would allow me to buy a 57. Yep. Okay. So that does work. I'm able to put on a ratio spread for only $7 on a stock that costs you $5,700 to own 100 shares of. So $7 is virtually zero on that. And if the stock is to rally, and again, this is only at expiration. So if the stock rallies to about so this is where I'd have to do a little bit of math, but basically what I have to calculate is the cost basis between 61 minus $1.84 plus the roughly $1.84 that I have to pay for the 57.5 vertical spread. And my break even is probably going to be somewhere in between around $59 or so, I'd say. Will be my true break even on the underlying stock. So the stock, if it rallies back up to 59 or so here by November 18th, which is right where the crosshairs are right here, that would be the most ideal scenario for this particular trade. If it does rally back up to 61, that would be where I would make, I'm sorry, 59 is where I break even. 61 is your best case scenario. Anything above 61, you start to underperform. If it continues to move lower, you will basically lose the same amount of money as if you held on to the stock. So First Solar, the good first example, was able to find one. Carlos is saying AA. So Carlos, your cost basis on this stock is $19.35, which is only 35 cents below the current price. So I wouldn't say that that's a good candidate for a repair strategy because first of all, there are no strikes between 19 and 19.35. And you're simply not down large enough in my opinion, on this particular trade. You're down about 1%. So I wouldn't put on a repair trade for this specific stock. Eric is saying that he owns Exxon from 74.20. So I feel like that's probably going to be too big of a move to even get back to break even. But let's take a look. Let's take a look at a break even here. A short call. Oh, sorry. A short call ratio. So you're short these, I'm sorry, your cost basis is 74. So notice how if I sold the 74 calls, I'm only collecting 2 cents. That's not enough to pay for basically anything. So again, this is a stock that in my opinion has gone too far against you to try to repair. Any type of repair strategy that you do put on is going to cost you money. So as you can see, selling 2 contracts of the 74 only collects 2 cents, but I have to pay $2.30 to buy that $67.5 call. So in my opinion, might be time to just cut your losses and move on this particular trade. Nor has Lightspeed. That is a Canadian stock. That's why it's not coming up. So sorry, we're only looking at US stocks. So let's look at Applied Materials next. Stewart owns Applied Materials at $60. So you must have had the stock from a long time ago. Again, this stock is well down more than 10%. I'm pretty sure we won't be able to find anything here. Again, if you're down more than 10%, I don't believe you will be able to find you a short call ratio, because if I sold a $60 call, I'm only collecting 15 cents. To buy an at the money call cost me $2.47. Those two do not come close to netting each other out. So again, on Applied Materials, not possible to put on a repair trade. Dennis is saying, if you put this spread, Disney spread on, where and how would you get out at a profit or loss? I hope that I showed that to you guys in that particular example. Lou's saying that he bought blue at 93. 93. Okay, so I think 93 is possible here. Let's take a look. Let's look at short call ratio. I like to look at the weeklies. Oh, actually, there's only monthlies on this. So your cost basis on this is, sorry, what was it? 93. So there are no 93s, but there are 95s that we can sell, which will give you $4. That will roughly pay for 2 contracts of the 85. So in this particular case, we were able to find one. You can even do one on a small credit. So you actually receive $50 out of the $100 for every 100 shares. And that would allow you to get yourself back to break even somewhere between roughly about 90 bucks. So if the stock does rally up to 90 bucks by November 15th, you will make, you will basically break even. And if the stock does rally to 95, you will make roughly about $1,000, a little bit more than that on this particular trade. Now, harder to find because they don't have exact strikes. You only have $5 strikes, but I think that's close enough. Molly is saying Newmont Mining, a cost basis of $38.75. Molly, I think your example is similar to Carlos's example in American Airlines. This simply is not down enough for you to even consider putting on a repair strategy. You're only down about 50 cents or so on this. Not enough, in my opinion, to consider putting on a repair strategy. Patrick, your P&L does not include the long stock, right? That's correct. This does not include the long stock. The P&L is just on your repair piece of the trade. Eric is saying, would it be better to use October? I think you're referring to maybe the Disney example. Would it be better to use a shorter dated option? Absolutely. You might find it difficult to find, I went out to November, but let's say I went out to October, right? So what did I say? We had a 128, which cost you $2.55. How far out could you go to sell, to write off? Well, those are puts, sorry. Also puts whoops. So if I bought the 120, if I bought the 128 calls, which were the at the money calls, or maybe the 129 calls, what did I have to sell off against that to? So you're right. So I'm sorry, who asked that question? Chris Lean asked, with Disney, or no, sorry. Oh, Eric asked, so would it be better to use October in the Disney example? So yes, if you are able to, if you do think the bounce is going to happen over a shorter period of time, you can use a shorter dated option. But you will find that you won't be able to sell that 134s. So the shorter you go, the less leeway you have here. So before in October, I was able to sell the 134s to pay for the 129s. For the Octobers, I can only sell the 132s. So the shorter time you go, the less wiggle room you have in terms of losses before you can put on a repair trade. So Eric, great question, but unfortunately, if you go too short, you may not be able to find strikes that make sense for you. Larry saying SFIX at 1990. So this stock is, you're down a little bit in my opinion. So this is not a bad, this is, I don't know that you'll be able to find exactly, but let's take a look. So Stitch Fix, I'm guessing does not have weekly options, but let's take a look. Short call ratio. Oh, it does have weekly options. So let's take a look. Maybe the November 1st, we sell the $20 because that's your cost basis. Can we buy an 18.5 with it? A little bit, roughly. If you get filled near the midpoint, you'd be able to do that. So yeah, you'd be able to find a ratio spread where you sold the 20s, which is close to your cost basis, and buying an 18.5, which is the at the money calls. And if the stock rallies back up to 18, I would say 1920 or so, I would say that's roughly where you would break even on this overall trade instead of 1990. And if the stock does make back up to 20 bucks, you basically break even on the stock and then you make 160 bucks a contract on the repair trade. Shantha is asking, hi, Tony, I really like you did ratio spreads. Would you also consider iron condors and butterfly spreads or condor spreads? If not, at least any strategy that you think is worthwhile. Could you please explain again the difference between buying a call and selling a put in relation to underlying stock price movement? Shantha, I believe that what you're asking is a little bit off topic of what we're discussing here today. I'm happy to address that, but let me address the questions first that are related to what we're talking about here today. Giovanni is saying, can you look at Activision, which was a daily play suggestion? So Giovanni, this was a trade that we recently just exited, but had a pretty big rally today, had this huge accumulation bar yesterday and held that 52 level support level. I do think that this may have a run to the upside, but I will say we simply got into this trade too early. We had to cut losses because it was exceeding our 50% rule and we got out. But I do think that if for those of you that are either still in this trade or maybe didn't get in initially, now might be a time to take another stab at a long trade, especially if you think this market can hold. Eric is asking HIG. You have a cost basis of $61. That I think is possibly feasible here. Let's take a look. Short call ratio, where your cost basis is 61. So let's see if we can find maybe a 61 strike that will give you only 28 cents in premium. Let's take a look. How much is a 58 or $58.50 call option? So notice how you have to pay $1.56 for an at the money call. You have this the 61 calls only give you 28 cents. I don't know. This does have earnings coming up, so I don't know if you can avoid that. Nope, not really. So I would say very difficult to do. Notice how big of a difference between the buy and the sell price now. If you do get filled at the midpoint, doesn't look a little better, but as you see, even at the midpoint, you're still paying $43. It can give you a little relief early. So again, if you do get that bounce, but on such a sharp decline, if you are expecting a sharp bounce, you may not get the repair strategy you really bargained for. So if the stock rallies back up to, let's say 60 and a half, but it doesn't next week, here, even if volatility comes down a little, you're really not getting much from your repair strategy. You really have to hold this all the way through expiration before you're able to realize those gains. So it really depends on what your viewpoint is on Hartford. Larry, I think I talked about SFix. Giovanni, the cost is about $55. How do you run into risk of assignment with a short call ratio spread? Great question. So you have, generally speaking, you don't really have risk of assignment unless the stock rallies above your strike price, which is, back to your break-even price, essentially. That's the only time when you do have assignment risk. And you do own 100 shares of the stock, which means that will cover one contract of the assignment. But if the second leg gets assigned, you can always exercise the long leg of your call to pay for that, to deliver the assignment on the short legs. So you generally don't have a lot of assignment risk from this because the stock really needs to rally significantly for that to happen. And if it does, you are covered from the fact that you have the stock and you have a long call leg that you can utilize to deliver those shares. So with that, I think that covers everything that I wanted to discuss with you here today. I hope that this was everything that you guys wanted to see as far as a stock repair trade. I know a lot of you have asked about this type of strategy and for me to go over this. So I hope that I was able to cover everything with you and show you guys, the trade itself, break it down into components that hopefully you can understand, show you how to analyze it using options play. But more importantly, I hope that I showed you what it actually takes for one of these strategies to work out. And many times there are a lot of places where it doesn't quite work out as well as you would like it to. So be aware of the limitations of this strategy. It's not some magical pill that will just save every single losing stock trade that you have. You must have a stock trade that hasn't lost too much, that you think is going to bounce back relatively slowly, that is when an earnings a repair trade may make sense for you. So with that, I want to thank everyone for taking the time out here this afternoon. If you have any questions regarding anything I discussed here today, please type them into the chat window and I'll try to answer as many questions as I have time for. I know there are a lot of questions already here in this queue, so I'll try to take them as quickly as possible. And just a quick reminder for those of you that don't already have Options Play, please sign up using this link here, which I will post into the chat window. And I hope that you guys choose to subscribe to Options Play so that you can utilize this tool for looking at repair trades, but more likely lots of other trades for you to get into, such as the Activision one that Giovanni brought up here earlier. So let's see. James is asking, oh, James logged out here. So Kaushik is asking how to repair options trade gone against. Great question, Kaushik. My 2 cents and my philosophy that I've always had with all of these trades is that if an options trade has gone wrong, you need to cut your losses and move on. It depends on what type of options trade you have as to when you want to cut your losses. But there is no magic pill that repairs an options trade that has gone wrong, because any repair trade there will typically add on more risk, and you never want to add on more risk to a trade that you've already lost money on. So if an options trade has gone against you, cut your losses, move on. Ed is asking, Ed, unfortunately, I don't have enough time to go through more examples, but hopefully I showed you enough examples to show you when it works, when it doesn't work, and giving you guys a sense for how to utilize Options Play to find these repair strategies on your own. Donald, how important is liquidity in terms of bid-ask spreads and volume open interest for this strategy? Great question. So bid-ask spreads, in my opinion, are very important because you are trading 3 legs, probably more than what you typically trade. Volume and open interest, not a big concern of mine. As long as your spreads are tight, you're good, because volume and open interest is just a indication of whether or not other people traded it. Has nothing to do with liquidity. You know, if you look at open interest and volume, they just tend to pool around, you know, at the money and round numbers, but doesn't mean that the odd numbers or stuff that's out of the money is any less liquid. So keep that in mind. Let's see. Could you sell more than 2 calls, realizing this will add more risk if stock goes higher? You can, but that also means that you're naked a call, and not everyone has the ability to short naked calls. You can, but I don't generally recommend doing that. Robert's saying, what if we have a good stock paying dividends we want to keep? Would selling bear call spread work? Would selling a bear call spread work? So selling a bear call spread would, I don't see why you would sell a bear call spread. Why wouldn't you just sell a cover call? Because a cover call would get you more premium, which gives you the small downside protection that you're looking for. I just don't see why you would sell a bear call spread. You've already protected the short call because you're long the stock. So if you have a good stock paying dividend that you want to keep, sell cover calls on it. So do you need time decay for the short ratio spread to work? Yes, it is extremely sensitive to time decay and volatility, because again, you're net short 2 contracts versus only the 1 contract that you're long. So you're short volatility and you're short time decay. So you need time decay and volatility to work in your favor. And delta is a relatively small component of the trade. And that's really what I think is most important to realize about this trade, is that your biggest exposure is not in delta, because the deltas almost net each other out. You're selling that out of the money call, but you're doing it twice versus that 1 long out of in the money call. That does skew in your favor as the trade starts to move in your favor, but your net delta is pretty low on this particular trade. You are short theta and volatility. So you want time decay to go on and you want volatility to decrease. it'd be very helpful if commissions could be factored into options play, especially in multi-leg trades like ratio spreads. I will say, with the announcement this week, pretty much commissions are going to zero, if not already at zero, pretty much at all brokerage firms. So yes, I certainly understand what you mean, but commissions are a thing of the past, to be perfectly honest. You know, the most expensive one on the street now is, I think, 65 cents a contract, which is nothing, you know, compared to the, even if you only collect 20 cents in premium, you know, 65 cents on a $20 contract is very, very little. It's a marginal amount of cost in your transaction cost. What's far bigger transaction cost is the bid-ask spread. So keep in mind that your bid-ask spread is really, notice how the difference between getting filled at the midpoint of getting a 43-cent debit versus a $100 debit, that's a $60 difference. You know, 60 cents is not going to make any dent on a $60 spread. So I hope that, commissions is really something that I know has eaten away into a lot of people's trades, especially in small dollar amounts. And I think this is really good for the industry, for retail traders to be able to trade effectively commission free. Giovanni, Karen, thank you so much. I really appreciate it. Joan is asking, what's on for next week? That's a great question, Joan. I can find out in 1 second here. I believe I'm going to be covering a discounted stock purchase with cash secured puts. So next week, I will be covering cash secured puts as an alternative to buying a stock. Very underutilized strategy. I think it's a strategy that all equity investors should be familiar with and trading. So I hope to see you there for those of you that are not familiar with the cash secured put. And our Christopher is asking, when is our next webinar? All of our webinars are at the same time every single week, Thursdays at 4:15 p.m. Eastern. Can you repair a debit spread? In theory, you could. But the reason that you can't use this strategy on a debit spread is because the only reason you're able to do this is because you're long the stock, which means that you can use the long stock to sell that extra call that you need to pay for that call spread. You can't do that on a debit spread. And that's why, generally speaking, if the debit spread's gone against you, cut your losses and move on. A debit spread is meant to be a short-term bet in the markets. And that bet either works out or it doesn't. And if it doesn't work out, there's really no point in trying to repair it. Admit the fact that you're wrong and move on to the next trade. That's the best chance of succeeding long-term with trading. If you were constantly holding on to the idea of not losing, I promise you that's when you will lose the biggest, because if you consistently try to do different things or repair a strategy, add on more risk, the next thing you know, at some point you will find yourself in a bigger hole than you intended to begin with. Jake is saying, new to your platform, don't see spread strategies spelled out. Jake, I'm not sure what you mean by that. So as you can see, for any strategy that you type in, you can either click on I'm bullish and see 3 strategies, which includes a spread trade, or I'm bearish, which also includes a spread trade. If you have a specific spread trade in mind, please let me know. I'm happy to provide that to you. Al is saying, how do I sign up for the 12 free sessions for options trading? Al, you can send me an email at info@optionsplay.com, and I'm happy to send you the link for that. KCAV, still waiting for instructions for free trial, but system says expired. So if your free trial has expired, please consider being a member and supporting us. It is just $75 a month or $500 a year. If you're not sure that this is something you want to do long-term, I recommend that you start on the monthly plan before you decide to commit to an annual subscription. Giovanni, why don't you send me an email at info@optionsplay.com, and I'll happy to answer that question for you. And same thing to you, Shantha. Your question about ratio spreads and iron condors, butterflies, and the difference between buying a call and selling a put. Great questions, but I think a little off topic for what we're discussing here today, but I do want to address that. So send me an email at info@optionsplay.com. Donald Johnson is saying, how important are options play technical scores and options play trade scores in evaluating repair opportunities? So I would say technical scores are pretty important because what the technical score tells us is the relative strength of a stock. And Donald, I think you and I have had some discussions around relative strength and how important it is. It is a very important piece of my trading. I wouldn't go long any stock that didn't have strong relative strength, or at least showing strong relative strength in the short term. So I do think that that's very heavily dependent on this. So if you have a stock that's maybe like, what's a good stock? Maybe like a stock like this, I probably would be more weary about putting on a repair strategy with relatively weak relative strength, because that shows me that it maybe has a higher probability of moving lower than higher. That's my personal opinion on that. Donald saying, do you recommend just selling cover calls against a losing position until you break even? If stock rallies, you make a profit. It might take several months to get back to break even. In my opinion, that's a far easier way to try to provide some kind of downside protection on your stock. Just that, cover calls may not provide enough premium. And you may end up selling your stock at a loss on a cover call if you're severely down on that stock and you're selling cover calls on it. So you can, but there are different risks, if you will, to selling cover calls. Ursula is asking a great question. Do you have any idea why commissions are all going to zero? I can answer that question very easily. They're all going to zero because Schwab announced $0 commissions, so everyone else on the street has to follow them. How do they make money? Great question as well. If you look at firms like TD Ameritrade, they derive about 25% of their revenue from commissions. Firms like Schwab only derive 6% of their revenues from commissions. Most of their money they make is on cash. So the money that you have in your account, they're earning interest on. That's the predominant money maker for most brokerage firms. Commissions is a relatively small piece. The other thing is they also make money on payment for order flow, meaning they send your order flow to certain venues that pay them for that order flow, and that's how they predominantly make their money. So commissions was becoming a smaller and smaller piece of their revenues, and they decided to forego that to provide cheaper trades, in hoping that you will trade more and bring more assets to them. So that is how these firms make money. And Donald saying, note that E-Trade offers active options traders fees of only 50 cents a contract, as opposed to 65 that I believe Schwab and TD have announced. So good point, Donald. For those of you that are extremely price sensitive, take a look at E-Trade. They're offering only 50 cents a contract. Molly, you're very welcome. Can you do an auto stop loss for credit spread? Jimmy, that really depends on your brokerage firm. I do know some brokerage firms that do provide stop losses on spread trades. Other firms do not. So I would simply call your broker and ask them. They should be able to help you out with that. Larry's asking, if doubling your holdings would bring your cost basis to a 5 to 10% loss, would this strategy work? Larry, would doubling your holdings bring your cost basis? Larry, so are you suggesting that if you bought more stock and now your cost basis is within that 5 to 10%, would you then put on a repair strategy? Yeah, so I guess if you're willing to put on a number, first of all, if you're willing to double your risk on an already losing trade, I wouldn't advocate for that personally. But if you were comfortable doing that, then yes, you can do that. But I would then, play around with the ratio spread first to see, even if you were able to bring your cost basis lower, would a ratio spread work with the new cost basis? And keep in mind, there's still all the other things that have to line up. So make sure that you're aware of those things, because you could get a small bounce that, very quickly, and the repair strategy does not provide you with the returns that you're really looking for. You really need more of a slower burn in that increase. And I would only do it if you're pretty sure or convicted that you are near a bottom and the stock will bounce from the current price. You don't want to just buy the stock, and to lower your cost basis at any point. Michael saying, would a collar trade be better for stock you want to hold on to? Michael, a collar trade is better suited if you're bearish on a stock that you want to hold on to. I wouldn't necessarily put on a collar on a stock that you think is going to continue moving higher, because to put on a collar, you have to sell a pretty aggressive cover call to pay for that put. Many times you're really capping the upside of your stock to put on a collar. So that is another strategy that I will cover in a future webinar, because that is, I would say, the second most requested topic beyond a repair strategy. Patrick, you're very welcome. Thank you so much. Do you see zero commissions in Canada? No, I do not see zero commissions in Canada. So Canada does not have the same payment for order flow, which is why I don't believe they will ever move, or I don't believe they are going to move to zero commissions anytime soon. Irina, you're very welcome. Michael, Patrick, everyone, thank you so much. I appreciate it. Any last questions before I sign off for today? Off topic, would you consider addressing diagonal spreads? So I actually addressed diagonal spreads during our webinar on leap options, but a diagonal spread is really no different than a cover call from my perspective. You know, you would sell the call or the put the same way you would sell a cover call. So I'm not sure that there's enough material there to cover on a whole webinar, but if you want to learn more about diagonals, I do recommend that you take a look at our previously recorded webinar on leaps, because I do cover going long the call and then shorting a short-term call against that. Claude is asking, is this recorded? Absolutely. Donald Johnson, thank you so much. I appreciate it. Don, I sent you an email earlier today, so I hope that you've had a chance to take a look. What will be the best broker when you are outside the US? I guess that really depends on which country you live in, and Christopher, I stepped away. Is there another webinar coming up soon? We do a webinar every Thursday at 4 p.m., 4:15 p.m. every single Thursday. So that's one of the things that I think, you know, it makes it easier for everyone to attend, is that it's at the same time every single week. Jake, your call spread, your terminology is short vertical call. Jake, I'm not sure what the question is there. And South Africa. I don't know of any South African brokers, to be perfectly honest, but you might want to check out Interactive Brokers. They do have a pretty large footprint throughout the world, and I think it's probably one of the better brokers if you do need to trade international markets. I know there are a lot of South African brokers. I just don't know of them myself. Anna, Serge, Ursula, Christopher, thank you so much. Any other questions? If there are no other questions, I just want to thank everyone for taking the time out here this afternoon. I really hope that you guys have found this topic useful. You know, may not be exactly what you were hoping for, some kind of magic pill that fixes all your losing trades, but hopefully this helps you in finding some relief in some losing trades. And hopefully this helps also solidify the fact that there are some trades you simply should just cut your losses and move on, and save yourself the headache of trying to do all these things to prevent yourself from taking a loss, which again, many times I find just only puts you into a bigger hole in the long run. So with that, thank you so much. Happy trading, happy Thursday, and I'll see you guys next week. I hope you guys have a great evening.